Although nearly a week has passed since the US non-farm payrolls were released, the euphoria from the stronger-than-expected data is still fueling optimism in the markets. Most investors are now considering the scenario of a soft landing or no landing for the US economy to be realistic. In this context, the US dollar is carrying on with its steady rally, while stock indexes on Wall Street closed yesterday's session at a record highs. The joint rally of dollar-denominated assets was also supported by the minutes from the Fed Reserve's September meeting released yesterday. The minutes stated that the first outsized rate cut by a half a percentage point should not be interpreted as a sign of a less favorable economic prospects, as an indication that the pace of a policy easing would be faster than expected. Likewise, yesterday, a similar statement came from the Lori Logan, the Dallas Fed Reserve president. She said that gradual further monetary easing would likely be appropriate following the 50 basis point rate cut in September. Changing expectations for the Fed Reserve rate in the US encouraged the US dollar strengthening. As a result, the dollar index, which tracks its value against six major rivals, jumped to a 2-month high. On early Thursday, the US dollar index consolidated within the daily range of 102.80 to 102.90 points, and there is a very good reason for this. Interestingly, after the publication of the Fed minutes, US stocks also continued to grow. As a result, the S&P 500 closed yesterday with a jump of more than 1% and opened today also on the rise, trading in the range of 5,745 to 5,797. It looks like Wall Street is anticipating a corporate earnings season in an elevated mood. The first financial reports will be available already this Friday. However, today, investor sentiment and the further rally of the US dollar are entirely dependent on the upcoming US inflation data. The annual rate of consumer inflation is expected to ease its growth to 2.3% in September from a 2.5% a month ago. This would bring inflation closer to the official annual target of around 2%. In other words, softer inflation data would reduce expectations of a sharper future rate cut, so it will be bullish for the US dollar. The paradox of today's report is that a stronger than expected CPI could revive the risk of inflation remaining at its current level in the United States, which would also allow the dollar to continue its steady rally. So the question is, how high could the greenback go? Even though the US dollar is overbought and the market needs at least a local correction, the euro-dollar pair looks very vulnerable today. However, the euro remains under selling pressure not only in anticipation of the US inflation data, and the euro is wind down as inflation in the eurozone has already slipped to 1.8%, and this serves an argument for the European Central Bank to cut the refinancing rate by another 50 basis points by the end of the year. Additionally, the German government announced on a Wednesday that instead of the expected 0.3% growth, the country's economy is now projected to look a 0.2% decline, mainly due to the structural and the geopolitical issues. Meanwhile, the euro is trading near its new 8-week low today. The euro-dollar pair opened today ranging between 1.0931 and 1.0949. After this single currency failed to hold the key support level of 1.0950, it moved even deeper into bearish territory. It extended its decline by breaking through the next important level of 1.0935 against the US dollar. Given that technical indicators point to further weakening of the euro-dollar pair, the next major support and resistance zones could be 1.0935 and 1.1090 respectively. However, today much will depend on the US economic data. In the meantime, oil prices are trading higher. Despite US Energy Department data showing a sudden increase in stockpiles by 5.8 million barrels last week, a significant drop in crude oil prices has not followed. On the contrary, Brent crude futures, for example, rose by 0.4%, and today Brent crude is likely to extend its growth within the intraday range of $76.70 to $77.70 per barrel. Investors have to bear in mind the escalating tensions in the Middle East, which is currently the key catalyst. Besides, markets are facing a surge in demand due to a powerful storm that hit Florida. Considering all these developments, there are more and more reasons for oil prices to continue climbing. Therefore, our analysts believe that after a brief pause, oil prices will rise again. What about Russian currency? The ruble has stabilized today. It seems that investors have already factored in the potential suspension of trading on the Moscow exchange, and now everything will depend on the actions of regulators, both in Russia and China. If exchange trading becomes impossible, starting next week, participants will shift to over-the-counter transactions. And this shift will not so drastically change the situation, but it will still have a short-term impact, causing the ruble to weaken further. And however, if the People's Bank of China finds ways to protect its banks from secondary sanctions imposed by the United States Treasury, so the ruble could see a strong rise at the beginning of next week. Until then, the market is likely to take a wait-and-see approach. And as for the yuan's exchange rate, it seems to be more influenced by events within China. All eyes will now be on the press conference held by the country's Ministry of Finance, which is scheduled for Saturday. So he's expected to unveil details of large-scale measures in the near future. And given the growing skepticism surrounding Beijing's economic stimulus measures, such high expectations risk jumping into equally significant disappointment. So that's all for today. We continue to follow developments in financial markets. Subscribe to our channel and follow news with us. So see you soon.